Hey guys, if you've been following this channel for a while, you'll probably know by this point that I am heavily concentrated. I don't have the most diversified portfolio. Once upon a time I did, but I do not right now. The majority of my portfolio, the majority of my money is within two particular assets, two particular stocks even. Now, I don't have to tell you which ones, I'm sure. If you've watched this channel, you know which stocks I talk about all the time, Tesla and Palantir. But for quite a lot of people, especially when you're new, you hear this idea of diversification. You must diversify. If you do not diversify, you're gambling, you will lose all of your money. And you know, for a lot of people, that actually could be true. It could end up like that. Now, like I said, a long time ago, I did have a really diversified portfolio. But over the years and over the journey of getting interested in investing and learning and becoming quite fixated with the companies that I study, that has naturally led me to having a very undiversified portfolio. So I wanted to talk about it, but I'll share my allocation split in this video. I'll share which, how much percentage wise I have in Palantir, how much I have in Tesla, how much I have in a couple of other companies as well. But if you want more, regular updates on my portfolio, you want to know every time I buy and sell, you want to ask me questions about my portfolio, anything like that, come and join the Patreon. You can do that. You can also get weekly portfolio updates doing that, live buy and sells. And we have a Discord. It's a fantastic community. It's really building over there now. I'm absolutely loving it, speaking to you guys every day. I'll leave a link in the description and as a pinned comment if you want to come and check it out. Anyway, right now I have the majority of my money in Palantir and Tesla. Now, I guess to see why I have this, I have to think about the pros and cons to diversification. When you first get into investing and you start Googling, you start learning, you will very quickly be advised, whether that's by Google or anyone else, that you should diversify. Now, diversification takes many forms. What is true diversification within investing? I guess you could say diversification across different asset classes. So you could have in your portfolio real estate, bonds, stocks, gold, crypto, ETFs. That would be one way to diversify. But even within specific asset classes, so just take stocks for example, you can diversify by having growth stocks, with dividend stocks, with small caps, with large caps, with mid caps, with stocks from different sectors, with stocks from different countries across the world. You could have a global ETF that again, it gives you exposure into lots of different types of companies across the globe. There's many different ways to do it. So I guess you could actually come back down to this question of what is true diversification? Is an ETF actually even that diversified? Because actually most people that buy an ETF will probably be buying something like VU or an S&P 500 ETF or something like that, and actually the majority of the percentage of that ETF is concentrated across a few stocks. Apple, Amazon, Microsoft, these companies, these big mega cap companies, Nvidia, they actually take up the majority of the ETF. So you could argue that by buying that and only having that, you're not actually as diversified as maybe you were promised that you would be. Now, of course, it is more risky for the average person putting all of their money into just a couple or even just one stock, going all in. Why? Well, it's because if that does poorly, if that does badly, you will ultimately lose all of your money. Your eggs aren't split up across many baskets. Whereas if an average person purchased a bit of this, a bit of that, a bit of this, a bit of that, if one of those things doesn't do very well, the likelihood is that something else is doing okay, it's doing well, and it will balance out. And this means that over time, over many decades, if you have an S&P 500 ETF, you will pretty much be guaranteeing, and I use that word lightly because we never can guarantee anything in the world of investing, but you'll get market average returns. And market average returns are not to be sniffed at. Market average returns are very good. If the average person committed to investing every single month, every single week, putting their spare money into an ETF like an S&P 500 one across decades of their life, they will be financially better off than if they didn't. They'll be financially in a way better place, maybe even a millionaire. You don't just use compound interest calculators, than their neighbor that decided not to. It's how it works, it's how it always has. And that is the best thing for the majority of people. Why is that? Well, it's because of a few different reasons. One reason being that in order to outdo the average to outdo the index, to outdo the market, you have to buy something that is performing over a long period of time better than the market. That's really, really hard to do. And how do you do that? Well, you have to be able to pick those companies that are going to do that. And to do that requires so much understanding, so much time, so much commitment, so much research. And for the average person, they simply don't want to do that. And that is okay. It shouldn't deter them from investing. You know, it shouldn't stop them from investing. Just get market average returns and call it a day, because that is absolutely fantastic. Now, here's my problem with that. When I started, I did do exactly that. I actually purchased a few different ETFs. At one point, I maybe had like 3 Vanguard-based ETFs or index funds, and the returns were okay, for sure. I wasn't even thinking about the returns at that point because I had a long-term mindset. I knew that I wasn't going to be withdrawing any of this money for a long, long time. But what I started to actually notice is 3 things actually. I don't know if you saw that, a leaf just fell nearly on my head. The first thing is that there was a lot of crossover. Like I said, I had 2, 3, however many ETFs, however many index funds, and these different funds were actually giving me exposure to quite a lot of the same companies, which meant I was paying fees to hold these funds, which, you know, Vanguard fees are very, very small, so it didn't really matter. But ultimately, I was just having duplication. It didn't make sense to me. Number 2, I was getting more and more interested in investing. I was looking at what's actually in these funds. And, you know, aside from the top maybe 6 companies that I definitely heard about, your Apples, your Amazons, your Nvidias, your Teslas of the world, I knew about these. I knew enough, you know. Scroll to page 4, I've not even heard of that company. I have no idea what their financials look like. I don't even know what their CEO does. Do you know, I don't even know what sector they're in, you know. That was quite an issue for me because I don't like to not know what I hold in my portfolio. Third is that I was becoming quite interested in learning about companies, questioning what are these companies doing? How are they changing the world? How are they gaining market share? What new products, what innovation, what new products, what new markets are they tackling? All of these things were things that were quickly becoming very interesting. And because of that, I started researching particular companies more and more and more, finding out which were the best. Now, this whole idea of buy the best, ignore the rest. This is something that I learned from Keith Fitzgerald, which I've spoken to on this channel. He's a great guy, he's a great guy, very, very successful investor. You know, a great guy, loads and loads of value. Buy the best, ignore the rest. And that's exactly what I think I'm doing now. I am concentrating on those companies, those couple of companies, few companies that I know the most about. I spend every day, as sad as this sounds, you know, I make these videos, I spend every day thinking, learning, questioning, being updated on the news to do with these companies. I don't know everything. I do not know everything, especially for a company like Palantir. It's very technical. Learning exactly how ontology works and stuff, that is quite confusing. I'm trying my best, but you know, I understand these companies, I understand the risk, and that means that actually I've got to the point now where splitting my money across many other companies and actually having a diversified portfolio is way riskier for me. It feels way like I'm taking on more risk. It doesn't make sense for me to do that, so I'm not doing it. Now, when I first started, like I said, I had ETFs and index funds, and then I started to move into having more of a dividend portfolio. And if you've been here since that time that I had that, you know, thanks for sticking around. I do appreciate it. I still have some dividend stocks and ETFs, very small percentages, but you know, there's a reason people are dividend investors. Right now, for me, I'm concentrating more on the growth, and that's okay. And then I moved into a few select growth stocks. And this journey of going from ETFs, index funds, to dividends, to growth, to a few stocks is a very common journey that I'm seeing. The more people that I speak to in this environment, in this community of investors, have followed a similar journey. So there's something there. There's something that I want to understand there. Why are people taking these exact same steps? It's very interesting. Now, I think for some people, they will have a diversified portfolio and they will have 15, 16, 17, 25, 30 stocks in their portfolio. Now, for me personally, you know, it's up to you. You've got to do what's right for you. I could not have that many individual stocks in my portfolio. The reason is because I simply can't keep up with them. I can't know what 20 different companies are doing each and every day. I can't keep up with their earnings. I can't keep up with the latest interviews with the CEOs. It's too time consuming. It would be more than a full-time job. Even people that dedicate their life to this couldn't do that. It's literally impossible. So I think at that point, if you've got that many companies, you're actually just better off having an ETF. That's just, that's just my opinion anyway. Now, I do also think it's very important, if you are going to be all in or pretty much all in on 1, 2, 3, a very concentrated portfolio, you really do have to learn and adopt this long-term mindset. You have to be able to have a long enough time horizon to be okay with the volatility that comes with holding companies just like Palantir and Tesla. If they're the owner companies in your portfolio, you're going to see many, many times where your portfolio plummets, where it goes really, really high really quickly. They're very, very volatile positions. But if you have a long-term horizon, you will be invested throughout those ups and those downs. You can ride the waves of it going up and down, and it can, it can balance itself out. And over the long term, the point is that obviously you're focusing on good quality companies that are innovating, that are going to be the future, and the stock will catch up, and the intrinsic value and the stock will at some point in the future match, and you'll do very, very well. That's the whole point. And if you have this long-term mindset, it allows you to focus on the fundamentals, to focus on what the company is doing rather than the stock, to not get freaked out when the stock drops by 5% in a given day because of some fake news going on with Tesla, which happens quite a lot, honestly. Another thing that we can do to try and figure out our own strategy is actually ask ourselves and look into what the most successful, most famous investors have done themselves. The likes of Peter Lynch, Warren Buffett, these people. Now, it's very, very easy to look at, let's just use Warren Buffett as an example, to look at Warren Buffett right now and see that actually he has, he is kind of concentrated in terms of the percentage in each company, but he's got quite a diversified portfolio. He holds many, many companies. But it's no good us comparing ourselves at our current stage of our journey, being early on in our investing career, to someone that has been around for decades and decades and decades, and actually they're at the latter end of their investing career. We should instead be looking at what Warren Buffett was doing 50 years ago. And actually, what he was doing all that time ago was doubling down. He was concentrating his portfolio on a few big winners. Coca-Cola is a fantastic example of that. He wasn't diversifying his money across many, many, many stocks because, when you've got little money and you're trying to grow it, you have to take big bets, you have to take some risk for that to actually become anything. Unless, again, you want to add for a long, long time, decades and decades and decades, 50 years, and have market average returns, which, like I keep saying, is not a problem. I think it's this idea of being in the wealth generation stage versus the wealth preservation stage. If you're trying to grow your wealth, for me, a concentrated portfolio makes more sense. And then over time, as I'm trying to retain my wealth and have it actually, fund my lifestyle, if that's my goal, at that point, I'll probably diversify, maybe look into some dividend payers, things like that. That's the kind of natural progression that I'm looking for. So right now, as it stands, my portfolio is 42% Palantir, 41% Tesla, 7% Nvidia, and 5% Amazon. Now, I want to be very, very clear. This is not the money that I've put in, the money that I've invested. This is the percentage weighting to do with how much I put in and the performance of these companies. So 42% Palantir, 41% Tesla is pretty much my entire portfolio, very, very concentrated. But actually, by the amount I've originally invested, I've put more money into Tesla. But Palantir, over the time that I've had the portfolio, has done a lot better. Therefore, it has taken up a lot more of my portfolio than maybe, maybe it would if Tesla was also doing as well. I also have VUSA, which is an S&P 500 ETF. I don't add to it, I just reinvest the dividends. That's in a different account. That's going to just stay there for a long, long time. Maybe I'll pass that on to my children one day, whatever. But yeah, Tesla and Palantir are the main ones. Now, I do think it's really, really important to say that it's very individual. Depending on your specific time horizons, your risk tolerance, your goals, why you're investing, all of these things, that will determine how you actually invest. That will show you, that will tell you what type of investment portfolio you should have, because it doesn't make sense for everyone at their stages of life and their strategies to actually have a portfolio like mine. Like, I am taking on some risk, even though I don't see it like that. It's got to be up to you. It's got to be individual. Now, with having a portfolio like this, like I said, you do have to be willing to do research. You do have to be willing to know everything there is to know about the financials, the everything about these companies. Otherwise, you're just gambling. If you don't know, then you're just throwing a dart at a dartboard and hoping for the best. If you're struggling with that, if you really don't know how to analyze companies, if you really don't know how to find different companies to even look at in the first place, if you don't know how to stay on top of your companies, the little tips and tricks, if you don't know how to analyze a balance sheet, all these things, I've got a whole workshop. I spent, you know, so much time filming videos for this workshop. The workshop itself is like 4 hours. It's pretty in depth. If you want access to that, again, I'll leave that in the description below. I encourage you to leave your thoughts, your opinions on diversification versus concentration in terms of portfolios in the comments below. Let me know what yours looks like. Let me know if you have a concentrated portfolio like mine or not. And yeah, thank you so much for watching, and I'll see you in the next video.